Okay, we're starting the meeting, and we've got two speakers tonight. Mark's going to talk first, and then J.L. Lord second in an hour from now. And one of the most frequently demanded use of options, and the most obvious for most people, is to use the options to trade stocks. People already have opinions on stocks. They're used to trading stocks, and they'd like to understand as a basic fundamental how to use options to trade, to take a position on stocks, to profit from stocks. And they're a very rich vehicle for doing exactly that. And Mark has had quite a lot of experience, well, he has had a lot of experience trading them. It's another approach completely from using options in a neutral trade, which is probably where most people get the most exposure to using options. So this is nonetheless a completely viable approach, but you don't want to just buy a call or buy a put. Let me leave it to Mark, and let's give a warm welcome to Mark.
Well, hello, my name is Mark Mosley. I'm a professional trader. I've been trading for about 8 years, last time I counted. I've done a number of presentations for this group, which have been pretty well received. Some of this sort of builds on my previous work, but without further ado, I'm going to dive right in here. So I put this graph of the SPX, which is the S&P 500 for those who aren't familiar, just to show that this is the normal sort of graph that people are used to seeing. We have the potential pricing of the underlying on the vertical axis, and time is on the horizontal axis. And so I will build on that concept later in the program here. I just wanted to throw the standard disclaimer out there. This is not, I'm not a broker-dealer. This is for educational purposes only. If you have not read this publication by the Chicago Board Options Exchange, there's a link to it here, which will be in the slides. So you can look them up on the website and read about that. So one other thing I wanted to mention, I'm now accepting students for one-on-one coaching or assistance with finer details of Thinkorswim. If you're interested in that, shoot me an email and I will send you some information. So why directional butterflies? A lot of us do direction neutral approaches, which have been very popular. And my previous discussion of the what we call the 20-40-60, it's a delta neutral approach to options trading, which rather than trying to make money on a directional move, this makes money on the time decay of the option contracts themselves. So I've got a link to that presentation. You can watch that if you haven't seen that. But my this is just a suggestion. You can allocate your funds any way you wish. But in my own trading, I have approximately 80% in this. It's a slower moving strategy, this delta neutral approach. I use about 20% of my funds for faster moving strategies, like this call butterfly that I'm getting ready to dive into. Now these can be arranged as delta neutral, delta positive, or delta negative according to your bias. If you don't know what that means, I hope you will by the end of this talk, but let's move right along here. Some people have no clue what a butterfly is, and so this is a little diversion here that we put in. Perhaps the simplest option trade is to sell a put. Without doing anything else, you can sell a put, and this is a graph here So if you're not used to looking at these graphs, remember on the SPX, we had pricing along the vertical axis. This graph turns pricing on the horizontal axis here. And then across the middle of the screen, we have the zero. So this is profit and loss on your trade. And so if we were to sell a put, that's where you see this break in the expiration line. So the way you read these graphs is the blue line is your expiration line, and the purple line is what we call the T plus 0, or the time plus 0. Time plus 1 would be tomorrow. Time plus 2 would be 2 days out. So the purple line is your current line, and your blue line is at expiration. Now notice the slope of this line. If you were to sell a put and it stayed within this point at expiration, you would make your money here. In this case, we sold one. This is Facebook that I'm trading here. We sold one 185 strike put, which is corresponding to this little bend in the expiration line. We got $420 for that put, and as long as it stays within that line, we get to keep our whole $420 by August 17th. The problem with this strategy is it exposes us to unlimited risk on the downside. If I could scroll this graph over, you would see that the potential loss if the underlying was to really bomb is unlimited. So you could lose much more than the $420 you're trying to make. Most of us can't trade like this. So let me just move along here. A way to cap our losses would be to buy a lower put. So this is what's called a bull put spread. A lot of people do these for income, and we've had some other presentations on this, and this is a viable strategy. If you do this on something you're bullish on, and as it moves up, volatility comes out of the trade and time passes, and your T plus 0 line gravitates to this expiration line. So this is not a bad strategy, but there's quite a bit of slope to this line, you'll notice. Say Facebook gaps down big, we could be down money on our trade, and then we're hoping it goes back up. I try not to use hope in my options trading because the market doesn't care what I hope for, and so this is a viable strategy, but let's see if we can do better. So this is a bullish component, and let me also note the delta number down here. Delta is a measure of your directional risk. So if you're positive delta, you ideally want the stock to go up. If you're negative delta, you want the stock to go down. So in managing these trades, if we're bullish, we want a positive delta. If we're bearish, we want a negative delta. If we don't know, then we split it down the middle and try to keep it neutral. So let's move along, though. Building on that concept, so this lower half of this graph right here is the same trade I just showed you, but we've sold a bearish put spread on top of that to make a butterfly. And so the normal structure is 1, 2, and 1. We buy a put here, we sell 2 here, and we buy another one here. And so it makes this profit zone. Now, the current Facebook is currently, or at least when I did this presentation, it was trading here at about 195.99. So you'll notice in this example, we are below the money right now. So this would be fine if you're bearish. Notice the delta number here also. We're minus 1.21. This is a one-lot trade. A minus 1 delta is not huge, but the magnitude of that delta number changes according to how many contracts you're trading. So this is a very small trade, but this might be something you wanted to do if you were bearish on Facebook. So moving right along. Okay, so what I've done here is we've got a bull put spread. combined with the bearish put spread, and it creates this profit zone. Okay, so here is Facebook price chart as of July 2nd. So you might look at this graph and go, well, which way is it moving now? We just put in a bullish bar. These are daily bars on this graph. We came down from a high. It looks like we're bouncing off. So somewhere, my seat of the pants judgment would be somewhere in this area is where Facebook will be moving to next. And so as an example, I set this up, and this is roughly delta neutral. This says -1 delta, but we are roughly as close to delta neutral as we can get, and we're capturing the potential area that we might be moving. The low here, the high of this day was 196. So I'm guessing somewhere in there would be as good a guess as anything. And you'll notice our graph is capturing most of that range. So moving right along, what is delta neutral? Delta neutral is 0, but there's a whole spectrum, positive and negative. For my directional butterflies, sometimes I'm borrowing some of the ideas that we use in the 20-40-60 approach that I gave an earlier presentation on. But just to help you understand what I'm talking about with this delta business, I've got a number line here, and so this is first grade stuff. The magnitude of delta, though, changes according to the number of contracts you're trading. So anyway, positive numbers mean we expect the underlying to go up. Negative means we expect it to go down. A neutral delta hedges our best as possible either way. So delta considerations on entry. We might be a little positive delta or a little negative delta depending on our bias. So I use these trend channels oftentimes, and this, I'm not sure of the date here. Okay, this is July 10th. So you can see that the yellow line here would be the mean moving back in time. These are this is 2-hour bars on this chart, but you can see Facebook might be rolling over here a little bit. It's hard to tell, but generally this area is what we want to capture. And the beauty of this is we don't really have to be exactly right on our prognostication. Most people are trying to pick the latest stock that's going up, and they're either bullish or they're bearish. But there's a whole spectrum of points in between bullish and bearishness, and so we just want to pick where we think it's going within a certain range, and as long as it stays within that range, we make our money. Sometimes we make a lot of money, sometimes we just make a little money. As long as it stays roughly within our range, we usually do pretty well. So in this example, I said the top of the range is probably about 220. The bottom of the range is probably about 192. So if you can come up with a butterfly trade that captures that zone, you got a chance of making money. So here is one example that I put together to try to do something with that. Notice I think it's going to move up a little bit from where it was when I did this example, and Facebook was trading at 203 in this example, and so if it would just go up and time would elapse, we would wind up in this part of our chart here. So for a $1,000 trade, you got a halfway decent chance of at least making 50% on your money, and if it was to finish right here in the middle, which it never does, you could make over $3,000 on a $1,000 trade. I wouldn't try to bank on that. What we do in managing these trades is if we can get 20 to 30% on our money and close it down, you've done great. So this is just an example. Notice that positive delta, a delta of 9.8. So we would ideally, if we were sitting in this trade, we'd like it to move up. We'd like Facebook to move up. And so another way to look at this, in Thinkorswim, they have these day step lines. And so each one of these lines represents one day each one of these lines represents 7 days. So I put this trade on for August 24th, and you can see the range of possibilities of where you could make money. So for a $1,000 trade, you could easily make 500 bucks. Not so bad. So choosing an underlying. We'd like to look for high implied volatility. Now, you may not know what that is if you haven't been following options very long, but volatility equates to high option prices. You might also think of it as demand for the options. An unknown stock that's very thinly traded might have very little demand for its options, whereas a stock like Facebook, Amazon, Starbucks, a lot of people are trading these stocks, and so there's more volatility in them, and also uncertainty generates higher volatility. So anyway, you may have heard, if you watch Tasty Trade at all, you may have heard of IV percentile. IV percentile is the up-down movement of a stock's implied volatility over the previous year. So they recommend stocks greater than 50% IV percentile. So there's a lot of videos on the web about Tasty Trade and IV percentile. I would recommend maybe checking into that. But I use that as a rough guide. Generally, I find a stock that I like the IV percentile, and I will start setting up butterflies and see how I like them. And I'll get into the details here. Let me get a drink of water. Oops. Okay. Another thing about implied volatility, we have IV skew. Now, this is very hard to put into practice, but what IV skew is the variation across the different strike prices within one expiration of the implied volatility. So each strike price that you're looking at will have different implied volatilities, and we can graph that out, and how that lays out on a chart is our IV skew. Now, in my mind, implied volatility is kind of something that happens. It can hurt us, it can help us. The best we can hope for is to start with something with a high implied volatility, and then down here I've got a little chart that shows graphing implied volatility compared to historic volatility. So implied volatility is a forward-looking metric. It's really what the market is pricing, how much risk the market is pricing into the stock moving forward. Historical volatility is looking backwards. That's how much it actually did move. So it's much like the insurance business. If you were selling insurance to people, insuring their cars, and all of your customers were wrecking, and you were having to pay out more than you were taking in premiums, you would be in a bad way, and that would be a bad business structure. So what we're looking for is high implied volatility in relation to historic volatility. And there's ways to set your graphs in Thinkorswim up so that you can see this at the bottom of your price chart. And so I'm not going to talk too much about term structure because we're all in one expiration with our with these butterflies, so that doesn't really apply. Okay, trade guidelines. These butterflies I like to do 45 to 70 days typically. Sometimes I will go a little bit under 45 days. but you wind up getting a lot more slope in your T+0 line if you shorten the time frame. And so that slope equates to a risk. A gap down could put you down money on your trade. And so as a general rule of thumb, we want about 45 to 70 days. Longer time frames give you a safer graph because it flattens out your T+0 line and reduces your moment-to-moment risk in the trade.
Okay.
And I've got some footnotes here. Shorter term means more slope. Okay. Butterfly width. There's some advantages to going narrower, and I will show you that. I don't really have a set width. For a big instrument like Amazon, I might use 50-point wide wings on my butterflies. For a smaller instrument like Facebook, I might use 10-point wings. But you can, I'll illustrate some of these dynamics with the width. But basically, I plug in different widths till I find a combination that I like, and I'll show you that on some charts moving forward here. With the narrower butterfly, your T+0 line expands for a good ways outside your graph. So I'll try to illustrate that here in just a minute. As far as managing the trade, it's a day-to-day decision-making process. If we're too close to one end of the graph, it might be best to just close it down. I'll study the option graph, and I'm also studying the price graph. If the stock looks extremely bullish and we're blowing out the top and our trade has turned delta negative, I am bearishly positioned on a stock that's very bullish. And so in that case, a quick exit is recommended. I'm not adjusting these trades. If you get into trouble with the trade, I'm just saying take the loss, get away from it. Nobody likes to take a loss, but a $1,000 loss is much better than a $10,000 loss. And so, however big you're trading, and I would recommend trading small till you get the hang of it. Get out quickly if you're having trouble with the trade. I'm also looking at the delta theta ratio. So the delta is our magnitude of directionality, and our theta is what we're being paid to take that risk. And so, generally, I like to see a very small delta to a big theta. If this ratio gets to be over 50%, you're probably in trouble and probably ought to close the trade. And I want to exit these trades with 20 to 15 days to go. Or if we made our 15 to 30%, go on and exit. Okay, so here's another example. Netflix. Netflix is setting up pretty nicely, and in the upper right corner, this is the IV percentile that I was talking about earlier. Netflix is been a hot stock. There's a lot of people trading the options in Netflix. Its IV percentile when I did this was 69. So that's telling me if it's above 50, that's telling me there's more and more money in the options. And so we want to get some of that money if we can. So I'm just looking at the price chart and I'm eyeballing the upper and lower of the range. In this example, I'm saying about 385 to about 435 is where we might be moving forward.
You're looking at the range today.
Well, this is.
70 days out,
yes. Yes, yes. You know, we usually don't hold these till expiration. If I put a trade on now and I've made my 15 to 30% in 2 weeks, I'm going to go and close it. So 45 to 70 days out may not matter. Now, nobody knows where this is going to be in 45 to 70 days. It's all a guess. But we're kind of guessing based on previous history and trying to take a stab at it. You know, sure, it could go to $500. Sure, it could go to $300. It's all a guess. The experts don't even know. So Anyway, moving right along. Now this is a graph where I've got the implied volatility versus historic on the lower screen, and you can see this sets up pretty nicely. Implied volatility is much higher than actual volatility through this range, and so this looks attractive to me for a trade. Plus, over time, this is a 2-hour bars moving back till back to March. So you can see we're kind of following this trend. So this gives us some clues. And anyway, if we could cover a range in this area, if we think it's going up, we can position it slightly higher. But it's kind of an iterative process. I will put the midpoint where I think it's going. So in this example, Netflix is trading at 418. So where do I think it's going? I think it's going to about 420. Now, of course, that's just a guess. If it goes beyond, then we may have to pull the trade off and reapply. Some trades are just break evens. Other times you really kill it. Now, this is an example based on the chart I was just showing you. Netflix was at 414. You know, maybe 420 is too conservative. I mean, we could easily be at 430 before too long. But in this example, I want you to notice how flat this T+0 line is. So things that contribute to this line being flat are farther out in time and also a narrower butterfly, believe it or not. People try to think they want to capture it inside the butterfly, but when you narrow these things up, this is just 10 points wide. This is 410, 420, 430. So you put this on, you have very little downside risk. Notice the height of the graph below zero compared to the height of the graph above zero. The risk-reward ratio in this setup is very attractive. In this example, I've only got a positive delta of 0.14, which is pretty much neutral. So this is kind of a neutralish trade. If you were bullish, you might position this thing a little higher, maybe a 420, 430, 440. But in this example, you can risk $500 or $550 to possibly make who knows what. It should be pretty easy to double your money. You might make 1,000. You might make 200%. If you got really lucky and Netflix went up here and then came back, you could make $8,000 on your 550. But again, don't ever count on that. You're never going to land right in the middle of your butterfly. But here I took the same graph, but I applied a 10-day step. So each one of these lines is 10 days out, and you can see the huge range that we were able to encompass. So even if we got to 430, so we were wrong. 420 was a little too conservative as far as where we thought Netflix might go. We're at 430 or 440 even. Well, notice how these lines are running. You could make your $500 way up here at 440 even, moving forward in time. Now notice the dates over here on the bottom left. Those correspond to the colors of these lines, but I kind of put this in to show you. You're starting out with a graph that's looking like this with a seemingly narrow range of profitability, but in fact it's much wider than it would appear. So your lower break-even at expiration is way down here at 380 or something, and your break-even at expiration up top is 460. So that's a pretty wide range of profitability to put out $500. There is earnings. So, you know, earnings is something we have to kind of trade around. I don't trade the exact expiration that's most affected by earnings. This is on out in time. earnings always make me a little jittery, because even though I'm not trading the exact expiration that's affected by earnings, a big move could give us trouble. So, you know, you're right about that. But if you're trading stocks, that's a fact of life. Earnings come around every quarter, and usually if you're beyond earnings and the move is not too great, your trade still works out. But that is a potential pitfall. Okay, so this was an example using a wider butterfly on Netflix. Now this gives a pretty good coverage too, but we're using more money. And there's pluses and minuses to doing it either way. Personally, I like the smaller butterflies because you can do it for very little money and cover a pretty wide range. But this is an example of what are my wing widths. I think I've got 40-point wings on this. So this works too. I would just keep an eye on your delta and make sure that your directionality is represented by your delta matches your bias for the stock. So Netflix has been pretty strong. This might be too bearishly. I mean, this might need to be higher up on the scale here. I put the middle on this example at 420, and I don't know what Netflix closed at today. I did this last week, so it went down. Can we get a quote on Netflix? Anybody? Anyway, Netflix is, where's my Netflix? Netflix is at 412. Actually, it's about the same. We're covering a pretty nice range here, though. So even for this trade, roughly $1,000 investment, you know, to make 50% on your money should be pretty easy. To make 100% on your money is possible. To make even more, you're accepting more risk by trying to make a higher percentage. Most people advise taking a lower percentage, rinse and repeat. Take the trade off when you've made 15 to 30%, do it again. That way you're always keeping this T+0 line as flat as possible, which reduces your risk. The reason we want this T+0 line flat is, you know, Netflix could gap down tomorrow. It could gap down on earnings. It could gap up on earnings. But as long as our T+0 line is relatively flat, we're not going to get hurt too bad usually, unless it makes a ginormous move. So in practice, we want to keep that T+0 line as flat as possible. And one way we do that is trading far out from earnings. And so there you go. Okay, this is another example here. This is CRM, which is Salesforce. Now this one did not set up as well, and this is why I put it in. Notice the depth here compared to the height of the butterfly. And this is how much is this stock? $142. Generally, the higher dollar stocks work better for these things. This is also not a heavily traded stock. The IV percentile is only 31, so it's not such a great setup in terms of risk reward. Now, you might study the price chart and say, hey, but we're kind of covering the most likely range. I'm not so sure. I'd love to have less risk, which would reduce the slope of this T+0 line. And if we had a stock with a higher IV percentile, usually you would have a much shallower downside with a higher upside. So the risk reward in my mind is not all that attractive in this trade. And to illustrate that further is the day step on this one. Every 10 days, you can see we're really sucking wind to make much on this stock. You know, it looks like if you make $50, you're going to be killing it with quite a bit of downside potential. So I put that one in to show you what a bad setup looks like. this is kind of an iterative approach. I find a stock that I like. I try to set one up according to my bias on the direction. I see how it looks on the graph. If the risk reward is not good, I don't do it. But I'm always keeping an eye on my delta and saying, okay, am I bullish on the stock? If so, I want a positive delta. And so there you go. I guess that went faster than I thought. Does anybody have any questions?
Hey, Mark, great presentation. Thank you very much.
Sure.
I get it. What the risk reward of the first trade was much better. The bell-shaped butterfly was much taller. On the second, not so much. There's more risk.
Right.
Reward. But instead of plotting all these charts and figuring out which trade you want to take on what stock, I'm maybe missing what your point line was. How do I tell what stock is going to give me a better risk reward chart?
Mark?
I haven't plot them all. Is that the Bell test or the IV?
Mark, could you summarize the question for the?
Yeah. So the person was asking. So how can you use? How would you select the stock? So I'm using IV percentile, which if you track implied volatility on your price chart, you will notice it ramps up before each earnings. Maybe the about 6-week period before earnings, it's gradually climbing. At earnings, there's a lot of uncertainty around an earnings call. So after the earnings call, the volatility collapses on an individual stock. Now, you can scan within Thinkorswim and set a column up for IV percentile. And so you can scan in all optionable stocks, and you can sort them according to implied volatility percentile. And then I'll take the top ones if they're ones I've heard of. There's a lot of stocks that are thinly traded that nobody's really trading the options. I like to trade the ones that you see in the news: Facebook, Amazon, Starbucks, Netflix. So I pick the big names, and then I'll try to start setting up butterflies and see if I can capture a little bit of directionality there. So that's how I do it. It's on the Scan tab in Thinkorswim, and you can do all that. Didn't really put together slides showing how that's done, but it's pretty easy to do. And if you need any help, send me an email.
No, I'm interested in that topic too. So basically, there's a tab here called Scan, and that tab will give you, does that tab give you all optional stocks with IDs going from the top to the end, or just giving you percentile ID, where is the percentile? So let's say stock is one, and say 20% ID, 40%. Right now it's around 38. That one's giving you, or is it just giving you, here's everybody?
Well,
Mark, could you possibly summarize the question?
okay. So you're asking me, you're kind of asking me how to scan in Thinkorswim. And so I wish I'd prepared a slide for that, but it's not that hard to figure out if you'll play around with the Scan tab. Now, what I'll do, I did mention the historic to implied volatility, and that's another scanning parameter. So what I will do is I'll have it searched through all optionable stocks, and I'll say, okay, I only want IV percentiles greater than 50%. There's also a selection where you can compare implied volatility to historic volatility. And I will say, okay, I want implied volatility to be at least 4% higher than historic volatility. And so I will run that scan, and that'll give me a page full of information. And so I'll start whittling that down, and you can click on the top of each header also. So like you've got this list of hits in your scan. click on IV percentile and it'll rank them from 100 down to 50. And then I'll just start with the highest ones, or the ones that catch my eye, the ones I've heard of. And I don't know, I hope that helps. But it's a great tool, Thinkorswim's scanning tool. You can find these, and some don't always set up. But one month I made great money trading Wynn, the casino company. I doubled my investment that month. The next month I tried to go back into it, and it just was not setting up right according to the volatility. And so what's hot right now may not be hot next month, but that's a great tool, scanning tab in Thinkorswim. Yes?
So, did you talk about when you went through some external issues which will, president persona? Do you look at any of the news events related to stocks that you like?
Okay, yeah. So the person asked, do I follow news on the stocks and consider that in my trading? I do to a certain extent. It's tough to follow every little bit of news. I was reading the news regarding Wynn and trying to make some directional judgments on that. I think most everybody knows that the management of Wynn got involved in some accusations of this, that, and the other, and so the uncertainty actually helped the volatility in the stock. Uncertainty is a great driver of implied volatility. It's a great driver of option prices. So that really played into my hands that month. Now, I think what happened is my trade played out. I mean, I made my money, and then, the news situation with Wynn changed. They fired their board. They got somebody else in there. I don't know all the details, but basically the uncertainty kind of blew over. And so for the next trading period, it wasn't a good customer. So anyway, sure. Anybody else?
Question from the chat is, what risk reward are you looking for?
I love to see 1/3 risk to 2/3 reward is kind of a starting place. They don't all set up like that, but ideally that. And so I've been trying to come up with some rules regarding that, and I thought about a ratio that might be max loss to max gain. Now, as I've said already, you never hit max gain, but just as a yardstick to compare one setup versus another one, you might consider max loss divided by max gain. And, I'm looking for approximately 2/3 gain to a 1/3 risk.
Going back to the selection of the underlying, I think in the example of nested today that you mentioned, you try to go for 45 to 70 days to expiration, and you look for something like 30%, and then you just close the trade, and that might happen in 20 days into the trade. What do you do then? You're out of the stock that you researched, and you put all your analysis on the ID, and now you're out. Do you kind of sit it out, or you trade different stocks kind of every month?
So the caller asked, what do I do when I've set up this trade for 45 to 70 days? 20 or 30 days goes by, and I've made my 15 to 30%, and I've gotten out. What do I do then? I look for another stock. I might trade the same thing and roll it further out in time, back to my 45 to 70 days, or I might just look at other stocks, basically. If the stock is still setting up good, there's no reason I wouldn't give it another whirl. But oftentimes things change. Like we discussed, uncertainty drives the implied volatility, and maybe some of the uncertainties come out of that individual stock, so I might move on. but I might go back into it also.
Can you get good setup for the indexes and the track?
They have not worked as well in my experience, and I don't know exactly why. For one thing, this comparison of implied volatility to historical volatility, a lot of gurus recommend this metric, and the indexes are not setting up very well in this regard. So I've had much better luck trading individual stocks, at least this year. I've done it on indexes, but they don't always work as well. So. I do sometimes. I consider the news on the stock. If it's extremely volatile and I think it could really make a big move in one direction or the other, then I will get out of it before earnings. I'm not trading the earnings cycle that's most affected by the earnings call. I'd love to be at least a month later, maybe 6 weeks later, so that my position is not getting jerked around so much by the earnings. So anyway, be careful with earnings. They can really bite you. But yes, I will hold them to earnings.
I had on an earlier slide the question about whether puts or calls. I've always wondered why one was preferred over the other.
Okay, well,
volatility that
some people might say different things about. Okay, he was asking puts or calls. Which should you use? Generally, if it's something you're bullish on and it's moving up, I'll do it in the calls. If you're bearish, do it in the puts. Generally, you do not want to sell in the money options. So if it's something you're bullish on, there would be no way to structure a butterfly above the money and not be selling in the money options. And so if you stay away from selling in the money puts or in the money calls, then you would want to use the calls for a bullish trade and puts for a bearish trade. Okay, so the caller pointed out the fact that there's generally more money in the puts than the calls, and you're correct about that. But given the rule of thumb that you don't want to sell in the money options and you're bullish on something, you would have to use calls. And I've done it plenty of times and it's worked very well. So don't let that keep you from playing with calls, especially on some of these big stocks. They work very well. So, anybody else?
Your trades were debit trades, as I noticed. Am I correct?
Yes, correct.
Okay. So you're now expecting, you put out some money and you expect to buy it back at a higher price. So,
Well, you sell it. You buy going in, so it's a debit going in, and then it's a credit to close, as long as you're profitable.
yeah.
So
that's the nature of time on those trades.
Sure. Now, I haven't really mentioned iron butterflies. That's where you do the lower half in the puts and the upper half in the calls. And that's because we're generally directional with these trades. Now, some of my examples were close to neutral, but that was just because the projected movement in the stock was not all that far from where it was when I was putting the trade on it. So it might be just a small amount of directionality rather than heavily directional. But anyway, synthetically, puts and calls, iron butterflies versus all put butterflies, or all call butterflies, they're all synthetically equivalent. So don't let that stop you. Sure.
Curious how your results with this compare with 20, 40, 60 and how you decided on the 80%, 20% allocation of resources.
So the caller was asking how the results on this compare with 20, 40, 60 approach and how I came up with my allocation of 80% in the direction neutral, 20, 40, 60, 20% this way. It was really just kind of a seat of the pants judgment. Yeah, it may depend how much money you've got. If you've only got a little bit and you're really trying to grow it, maybe you want to do more this way. The 20, 40, 60 is somewhat a slow moving approach. It's slow to lose money, but it's also slow to make money. And you can get frustrated if you don't have a decent sized account that you're working with. These symmetrical butterflies, I mean, some of those examples were only $500. And so anyway, it has to conform to your personal financial situation probably, and how risky you want to play the game. I mean, this is somewhat a game, and you have to decide how much you want to put at risk, because you can blow up your account. Plenty of people have done it. So what I've done is put 80% in a safer approach, and this is somewhat riskier, but a nice payoff when they hit.
We can go on answering questions, Mark, or we can take some time to do some presentation, but we're going to have to end this in 5 or 10, a few minutes. So, but that's okay, because it's great to have the interaction too, and you can always come back and do some of the detailed stuff, but maybe we should give it to Mark for a few minutes here to wind up. I hate to say it.
Well, are there any more questions?
Speaking of risk, how much of your portfolio do you have at risk at any one time?
Well, I have several pools of money. Some are invested in stocks the old-fashioned way.
So let's take your options.
My option portfolio.
The question was, how much money have you got at stake here?
Well, I have a options portfolio that I pretty much have fully invested in options. I don't know if that answers your question.
Well, obviously you biased it by.
So,
I mean, if I'm just trying to think, you know, so like if you were to expect some unfortunate event, you could lose almost all of your option portfolio.
Well, you know, if New York City got nuked,
yeah,
or something like that, yeah, I would take an extreme beating. You know, day to day, I'm kind of betting the sky is not going to fall. You know, we really haven't talked hedging. Hedging is an overall portfolio concept, and I do some hedging with my 20, 40, 60s. This is kind of my play money. You know, I keep about 20% of my options account as, you know, fun money that I'm trying to make really grow. If I blew that up, you know, I'd still have a roof over my head and hopefully work my way back. But you know, options is a speculative game, and you can lose all you've got. So you have to be careful. As long as you keep an eye on your risk and keep a very flat T+0 line, we can tolerate a lot of movement in the underlyings usually without losing too much. So I hope that answers the question. There's always a risk, though.
You know, you have to look at the whole portfolio.
Yeah, don't gamble with your milk and eggs money. You know, don't gamble with the money you need to pay your house payment. Don't gamble with your kids' education money. Yeah, keep it small. at least until you're comfortable with it. But even then, keep it small. Like I said, like we were talking previously, you know, I feel like the 20-40-60 is the safer approach to put a larger chunk of money in. And so that's what I've done with my own account, is keep about 80% in kind of a slow moving trade that sometimes makes nothing because, yeah, it's just kind of slow moving. But I've done very well with the 20-40-60 also, so I'm not knocking that. It's a great strategy, and it's really the cornerstone of all of my trading. So if you understand the direction neutral approach, and you can tolerate movement either way. So day to day, I'm not like gritting my teeth on the market open going, oh my God, it needed to go down and it's going up. You know, and that's what so many people do who are directional traders. And you just don't know. Day to day, you know, one day Donald Trump's gonna do something and it goes down, and you know, you have to be able to weather those events, and we don't know when they're going to happen.
Have you made more? What have you done better at with the 24-60 or the butterfly?
So he's asking, what have I done better at with the 20-40-60 or these butterflies? From a purely percentage approach, I've done much better with these butterflies. I accept, yeah, options is all about trade-offs. And so for a safer trade, you might get less return. And so that's kind of the deal with the 20-40-60. I've done well with that, so I'm really not knocking that. And I would urge everybody to study that one if you're not familiar with it. 20-40-60, and the link is in the presentation. So anyway.
How do you want people to get copies of your slides in your email? Can you go back to that? Do you want them to or how do you want to get those?
Let me see. I think we're going to post these slides on the website for our group, so everybody will have access to the slides. There's my email. If you've got questions or you're interested in some coaching, feel free to shoot me an email.
You can just keep going, Mark, for a few minutes.
Okay. Let me see. You're probably going to need the slides to be able to do it, because it's a big long string of numbers and letters. But we'll get the slides for this posted on the website, so you'll be able to get them real soon. I'll send this to Don, and he'll know what to do with it. Email slide. There we go.
Mark, the problem I have with the 20-40-60 and the predecessor that which we're also going to hear about later, was it took forever. You bought this thing, you sit there and kind of watch it percolate, and then as the market was going up, you kind of got chewed up on the high side and finally got up and watched it go even. And so these turn around quicker.
Right.
And so one of the things I was thinking, and comment on this, is if the time frame you put things in, if you shorten them up, it costs you more, I understand.
Right.
If you shorten the period up, you find out quicker whether you're making money or not.
Well,
But you also, risk.
so the caller was asking, he pointed out a trade like the 20-40-60 is awfully slow to make money, and oftentimes gets chewed up on the top side, and you spend all this time and effort fooling with this thing and don't make anything. Whereas these butterflies are a little quicker moving, and he was suggesting maybe shortening the time frame on these butterflies. Shortening the time frame does not work very well, because it makes for a much steeper T+0 line. So a small movement in the underlying, like some analyst downgrades the stock or any number of other reasons, can make the thing move bigly. And so as long as we're on a flat T+0 line, we can stand pretty good movement in either direction. But as we get greedy, you've heard Tasty Trade say, oh, all this time decay happens right at the end, and so we need to grab that money real quick. Like, well, you can do that, but it makes for a very narrow sweet spot on your trade, and so you can get blown out very. More safety. And you were also mentioning how on the 20-40-60, a lot of people are getting eaten up on the top side. And my solution for that has been to put them on slightly delta positive. I was having the same problem, and we've had, you know, I mean, the market has been generally bullish, although we've had some choppy action this year. Last year was like straight up. And so it was month after month I was getting blown out on the top, and it finally occurred to me, why am I taking a neutral approach in a market that is so bullish? And so what I did is I shortened the upper leg on the 20-40-60 and made it a 20-40-57. And that gives you much more room on the upper wing that the stock can run out there. You're not getting hurt, you're still making money. So these days, yeah, I'm doing my 20-40-60s, really 20-40-57 generally.
You ever run these on sector ETFs, or the 2X, 3X ETFs, trying to mitigate the impacts?
The caller was asking, am I doing these on any ETFs? Really, I haven't seen good volatility in most of the ones I've looked at. So no, not really. I know people trade options on them, but they haven't worked very well for me. You set these graphs up and you're not able to get your 1/3 risk to 2/3 reward generally. And so, no, I don't do those.
When you put out butterfly in a position such as the next week example that was $10 wide, do you look at, let's say, the number of contracts you're going to do and distribute them among different butterflies with different widths, or you just take one butterfly and that's your only one trade with the underlying?
So the caller was asking, would I do multiple butterflies on the same stock? And no, usually I'm just doing one. If I find a stock where the implied volatility is setting up nicely, and I like the graph, I'll just do one. Now, that may be an idea for experimentation. Have more than one to cover a wider range. Have one hedging the other one basically, and I haven't really played with that. It might work, especially if the IV is setting up right, so you have a very shallow downside compared to your upside. That might work.
Yeah, I was wondering if that was like a cool thing, putting too many butterflies down. You have the lower population or different positions.
Well, you also run into the problem of managing all these things. I like to put on things that aren't a huge headache to manage. I am a full-time trader and I'm watching the screen a lot, but I got to get away from it sometimes and just go do something else. And so you can't have such a touchy situation with your trades that you got to be watching numbers all the time.
Would that put both into like a wavy iron butterfly? I mean, iron condor?
A wavy iron condor. Yes, there's probably some advantages to the butterflies over the condor. Generally, with butterflies, you're selling options closer to at the money, whereas generally with the condor, you're selling farther away options. I've done condors too. I don't like them as well because you don't get as flat of a T+0 line. You get a lot of slope generally, and so yes, they will work if you ultimately stay within your short strikes at expiration, but there's a much more slope to the T+0 line, and so for that reason, I'm not the biggest fan of condors. I like butterflies.
On average, at any one time, how many option trades do you have on?
So the caller asked, on average, how many option trades do I have on at any one time? In different underlyings, I've usually got one in SPX going. Total. I'm guessing I probably got about 8 at any one time. So I manage money. I've got several people I manage money for, and so their stuff plus mine, I might have 10. Anybody else? Okay, well, if there's no more questions, I'm going to wrap this up.
Oh, you can keep going, Mark.
Oh, okay.
For a while,
I don't know.
Well, let me get you some questions then.
How about our next guy? Is he coming in, or what's?
Well, we're working.
Yeah, we're working.
So, Ryan?
Ryan. These are the advanced strategies.
Can we repeat the question?
So the question was, what was the question now? How would I combine? Well, okay, another idea I've played with, and really, if we got time, we could pull up Thinkorswim here, but the idea of combination strategies where you do have more than one butterfly on the same underlying, or you've got a 20-40-60 that's run off the upper end, and you want to build a little call butterfly up there, similar to like the Rhino trade. Or another idea is stacking 20-40-60s up on each other. You've got one 20-40-60 and it's starting to get a little iffy on the upside. Layer another one on if you got the money, if you're not totally invested in your first one. So all that works. There's a really interesting guy, Tony Sizemore, has done some stuff on combination strategies. I actually took his course, and he was so confusing I didn't get that much out of it. But it was probably about 7 years ago too when I first started trading. So I'm sure I would understand what he's doing better now. But certainly combination strategies work, and the way to do that is to keep an eye on your Greeks and understand what those numbers are telling you. We talked quite a bit about delta and whether you're positive or negative, equating to bearish or bullish, but you also want to look at your theta. These are all theta positive trades, which means you want to be collecting money with the passage of time. You don't want to be paying out money. And so in managing a combination trade, if you've got two 20-40-60s stacked on top of each other, I've played with the idea of the delta theta ratio, and I think it works pretty well. If your delta becomes more than 50% of theta, you're starting to lose ground, and certainly you don't ever want to let a trade go negative theta, because then you're paying out money. And that's the problem with just buying a call or buying a put. When I first got into this, I was trading with my father, and he thought he was a big guru, and he was going to pick the next stock going to the moon, and so he was just buying calls. He said, anything you're bullish on, just buy a call. He lost a ton of money because he bought all these calls. They're all theta negative, which means every day that passes, you're losing money. And so my dad bought all these calls thinking, oh, I'm bullish. Well, nobody cares if you're bullish. And so, yeah, don't buy calls, don't buy puts usually. Now, some people do this, but they are looking at very precise movements on the price chart. And so if it's really making a turn, you might buy a call as a short-term play, but you don't want to hold that thing very long because time will eat you up.
One question, please excuse my ignorance here, what is time?
Oh, that is the, let me see, I have a link to it here.
Those are the deltas.
It's a direction neutral approach. It's a neutral delta. It starts out neutral anyway. The delta changes with movement in the underlying, but it's basically you are hedging your price movement in to a certain extent in either direction.
It is a butterfly.
Yeah, it's a big butterfly. Is what it is. It's a direction neutral butterfly, and because it's delta neutral, it gives you quite a bit of latitude in either direction. Oftentimes, we don't know which way the market's going. The smartest guys on Wall Street don't know which way it's going. I mean, they do have more info than we do, but they don't know when the next crash is coming. They don't know if it's going to be up next week. And so we don't know either. And so I'd like to make money either way. If it goes up next week, I want to make money. If it goes down next week, I want to make money. And so we can do that with the delta neutral approach. And rather than making money on the directionality or the directional movement of the underlying, we're making money on the time decay on the option contracts. So it's positive theta, which means we're getting paid every day as long as the underlying stays within a certain range. And usually it does. Sometimes it makes a big move and we have to close the trade down. But anyway, hope that helps. Well, I've done an earlier presentation on this, and I would recommend you watching that because it's good background info. Like I said, it's really the cornerstone of my trading. I do these call butterflies and things as a directional shot on things, and also as a way to some of the smaller accounts I work with to kind of juice them or make money a little quicker than the 20, 40, 60, which is a safer approach, but it's also much slower moving. So if you've only got $5,000, for example, the 20, 40, 60 is going to be painfully slow growing that money. So anyway. Yes.
So you mentioned when it goes negative theta, you're looking to get out, or the ratio of the delta to theta being below 6% or to a certain point. Is it the rate of change that you're looking at, or is it that it hits that negative theta and you're out?
It's pretty much it hits that. So the caller asked, what's my threshold on this? So usually if it hits 50% delta to theta, you're already in trouble. Under the normal course of managing a trade, generally it'll hang around under 30%. If it gets to 50 or 60%, you're probably in trouble on the trade, and I would consider closing them down. All of these trades, I've kind of adopted Andrew Faldy's notion that we're not going to adjust these things. If you study John Locke's work, he's doing all these adjustments, and it gets very complicated, and you have to have special software to keep track of all these adjustments. And you have to have money sitting on the sidelines that you can throw in on these adjustments. I don't like that approach. Andrew Faldy's notion, which I've adopted, is if a trade's gotten in trouble, you're much better off closing it down and starting a new trade rather than to throw money at a trade that's giving you trouble. Now, if the stock makes a big move and you're already down big money, it's awfully hard to push that button and lock in a big loss. But I've seen it happen so many times where traders get down on a trade and they're like, oh, but you know, if it'll just go up 15 points, I'll be okay. Well, you know, the market doesn't care about your trade, and it might happen, but oftentimes it doesn't happen. And I've seen a $1,500 trade turn into a $10,000 trade just very quickly. And so the advice is get away from them. If they've gone bad, you know, I try to get away from them if I go below zero on my profit and loss. You know, that doesn't always work out, but that's my advice. Yes.
On the loss part, you're kind of like zero throughout. So you have a threshold where you're catching up your profit. So I just want you to go over just real quickly your threshold and minimize the loss, stop the loss.
Well, I think what you're asking is, yeah, I did just say, if I go below zero, I'm out. But say that this trade, for example, now this is a bearish trade. Well, you start at zero is the thing. So you can't really say, oh, if this goes into negative numbers on the P&L, I'm out. When you start, you're at zero when you start. And so you have to give it some time. You have to have a little tolerance for some downside on your profit and loss. Also, during the day, volatility will make these numbers tick around like crazy. And sometimes, especially on a really volatile stock, you'll see the whole T+0 line shifting up and down a little bit. And that's the moment-to-moment volatility is changing all the prices on all these different trades. So to answer your question, you have to have a little tolerance for some downside, but if it gets too uncomfortable, get away from it. You know, if you can't handle a small loss, you ought to maybe just paper trade or find another hobby. Brian.
I think one thing that might be beneficial is talk about price discovery, how you might know that you're getting price before you go on trade. How you get in, not so much about the rules, but more about price and pay.
Well, for example, so the caller was asking about price discovery and how do I know that I'm getting a good price. And so it's kind of an iterative approach for me. It's starting out with stocks that have high IV percentile, and then I'll just set up butterflies on them. And then I want to see a nice risk reward. Like this chart on the screen right now has a very, very shallow downside compared to the height of this profit tent. So this is telling me, you know, the implied volatility numbers are computed, they're baked into this whole thing. And so if the graph looks right, it's telling me generally it might be a good bet. Now, I know that's kind of wishy-washy, but that's what I do. I try to get it at midpoint and just jump in. You know, you don't really know which way things are moving. I mean, you might on a moment-to-moment basis, if you had this on one screen and you had your price chart on another screen and Facebook is ticking up or ticking down, well, just because it's ticking up right now doesn't mean it's not going to be ticking down this afternoon. And so we don't really know. Our goal is to set up a big sweet spot, and hopefully the underlying gravitates into it. Now, it does. It does. This is the midpoint down here.
Throw it out of the market at midpoint. You're probably not going to get equity because you add a penny.
Yeah, sometimes it won't trigger at midpoint. I'll usually start at midpoint. If I'm just very so-so about it, I might go, you know, to my favor a few cents and see if I get a fill. But I'll go in and adjust the prices. If I throw out a trade out there, it doesn't get filled. You know, oftentimes if you see a good setup, it's better to just go on and get in it. Whether a few cents this way or that, yes, it's slippage, but it's the cost of doing business. And trading with my father, I've seen him like, oh, I'm not going to pay 36 cents. I want it for 32. So he's got it on for 32. I got it on for 36. I get filled. I call him back later this afternoon. Dad, did you ever get that order filled? No, still sitting there at 32. And now it's 45. And I'm like, well, I've made $400 today. What did you do? So the point is, sometimes it's better to just go on and get in there.
So he's gonna take you out of his wealth.
So are you always putting in limits, or do you trade the market order as well?
Oh, no, these are all limit orders, but at the midpoint. This quote that Thinkorswim is giving you is the midpoint. If you were to, normally once I mock a trade up here on the Analyze tab, you can right-click over in this corner, and it'll go confirm and send, and it'll give you, it'll show you what the midpoint and the market is, and yeah, I'm not putting in market orders. I'm always putting in limit orders at the midpoint generally. If they don't get filled, I'll pay up a few cents more to go on and get in the trade.
How long do you wait, 5 minutes, 10 minutes, or are you just constantly adjusting that?
It just depends on how impatient I am that day, and if I got something to do, if I got to be somewhere. Yeah.
Okay. Listen, that's a tremendous, thank you for all the excellent questions, excellent dialogue. We've got our, yeah, thank you, Mark. I really